This week we look at adjustments and closing transfers, which is included in Chapter 10 of your all-in-one textbook. For homework, make sure that you work through Chapter 10 in your textbook, that you watch the videos on the slides and the practical examples. Then you do the homework assignments 1 and 2 at the end of Chapter 10. And once you have received the solutions, print those solutions out, compare them with your own answers and make the necessary corrections. Then you try and do the questions again without the solutions next to you. The outcomes for this chapter, there are 2 sections to the chapter. Half of the chapter is devoted to adjustments and the other half to closing entries. So you need to understand why adjustments and closing entries are necessary. Then regarding adjustments, you need to be able to calculate and record the adjusting journal entries in the general journal. Then you need to post those journal entries to the general ledger and then prepare the post-adjustment trial balance. So it follows the same steps as what you have done for previous chapters, but now we're specifically doing the adjusting journal entries, posting those to the general ledger, and then preparing a trial balance once those accounts have been balanced, and that we call the post-adjustment trial balance. Then for the next section, you need to close off the nominal accounts by means of journal entries. Nominal accounts are all the income and expense accounts. You need to post those closing journal entries to the general ledger and then prepare what we call the post-closing trial balance. So once again, the same format as for all transactions, except that here you are doing closing journal entries, then you are posting them to the general ledger, balancing those relevant ledger accounts, and then preparing the post-closing trial balance. What you already need to know, the accrual concept, which you learned about in Chapter 1, says that transactions must be recorded when they occur. You must not wait until cash is received or paid before recording a transaction. In Chapter 9, where you learned about income and expenses, you learned there that income must be earned before it can be recognized as income. So a trading entity must sell the goods before it can recognize those sales as income. And your service entity must render services before it can recognize those services as income, and that we call the realization concept. Then regarding expenses, you learned that they must be recognized in the period in which they are incurred. So it follows the same principle as income, but with expenses they need to be incurred before you can recognize them. And then another instance where expenses can also be recognized is when the income resulting from that expense is realized, and that we call the matching principle. So when an expense is incurred and it immediately results in income, then you will recognize the expense and the income together. And then something else that you need to know is that gross profit equals net sales less cost of sales. And you must also know the formula for cost of sales, which is opening inventory plus net purchases, which is purchases minus purchases returns, plus other costs on purchases, for example, freight on purchases, customs duty or import duty, less closing inventory. That will give you your cost of sales. Now we go on to the new work for this chapter, adjustments. This is the first section of the chapter. The information in the financial statements must be accurate. In other words, all the figures in the financial statements must be applicable to the current financial period. So then we need to look at what is applicable to the current period and what perhaps belongs to the previous or future periods. So what belongs to the current period is only the income and expenses for that period, and only those income and expenses may be included in the financial statements for that period. And then any income or expenses for other periods need to be taken out, and we use the adjusting journal entries to do that. Adjustments that you have already done. Closing inventory in Chapter 4, that is an adjustment. That's where you debit inventory, credit cost of sales. Your depreciation journal entries are also adjustments. Your credit losses journal entries are also adjustments. And consumables, that is where you perhaps keep inventory of consumables. So if there are consumables on hand at the end of the year, or even stationery on hand at the end of the year, which is also a consumable, then you would need to debit consumables or stationery on hand and credit the expense. And that is also an adjustment journal entry. The new adjustments that you will need to learn about then in this section: income received in advance, accrued income, that's income owing, prepaid expenses, and accrued expenses. Those are expenses that are owing. Adjusting journal entries are then done at the end of every financial period. And what is extremely important is that the purpose for adjusting journal entries is so that the income and expenses only for the current year are shown in the statement of profit or loss for the current year. So that is extremely important. The reason for doing adjusting journal entries is to make sure that our income and expense amounts in the statement of profit or loss are accurate. Now we look at each of those adjusting journal entries separately. Income received in advance. So this tells you have received income in advance of earning that income. Remember, you recognize income when it is earned. So income received in advance means you've received income, but you have not yet earned it. So you've received it during the current period. You have been paid for the service or for the goods, but you have not yet sold those goods or delivered that service. So you have not yet earned that income. In other words, that amount that was received for services in advance or for goods sold in advance for which you received payment belongs to the next financial period. So income received in advance must be taken out of the current year's figures and transferred to the next financial period. We will now look at an example for income received in advance. The entity rented out office space from 1 January to 31 December 2000X at 1,000 Rand per month. And as you know, from January to December is 12 months. But the amount of the rent received that shows in the trial balance is 13,000 Rand. So now we need to look at what income belongs to the current year, what amount does not belong to the current year that is for next year. So the current year's income is the 1,000 Rand per month times the 12 months in the current year. So it's 12,000 Rand rent income for the current year. But we have received 13,000 Rand. So that excess 1,000 Rand does not belong to the current year. It needs to be taken out of the 13,000 Rand and kept aside for next year. So the solution then is to do a journal entry. Debit the rent income with 1,000 Rand. Remember, rent income has a total of 13,000 Rand on the credit side. Debit bank, credit rent income each time 1,000 Rand is received. In total 13,000 Rand. But that 13,000 Rand credit is too much. It should only be 12. So in order to reduce that 13,000 to 12, you need to debit the rent income account with the 1,000 Rand. So if you balance that rent income account, then it will have a balance of 12,000 Rand. And then we credit what we call a rent received in advance account. And this rent received in advance account is a statement of financial position account. So it's included in the statement of financial position, not the statement of profit or loss. And because we are crediting rent received in advance, it will fall under current liabilities. Remember, current liabilities usually have credit balances. But if you reason that this client who is renting office space from the entity, if he should perhaps cancel that rental contract and say, I don't want to rent the office space anymore, I don't need it anymore, that 1,000 Rand that the entity has received from him for January 2001 would have to be paid back to him. So in effect, the entity would owe that money to the client if he decided to cancel the service. So if that client decided to cancel the rental contract, the entity would have to pay him that 1,000 Rand back, and that is why we credit rent received in advance and then include it under current liabilities. Second new adjustment journal entry is accrued income. Remember I said that is income that is owing. So it is income that the business has already earned, but the client has not yet paid them. It is owing to the business. So it is earned during the current period, but not yet received. And because it's been earned during the current period, you need to recognize that income in the current period in spite of not having received cash. So remember the accrual concept and the realization concept. The accrual concept says recognize transactions when they occur, not when cash is received or paid, or not only when cash is received or paid. And the realization concept says you need to recognize income when it is earned. So for this particular type of income, the goods have already been sold, or the service has been rendered, but the client has just not paid the business. So it has been earned, it must be recognized as income. So then it needs to be included in the current financial period because it belongs to the current financial period. Looking at an example for accrued income, the entity invested 50,000 Rand in a fixed deposit earning 8% interest per annum. The interest for the 12 months ending 31 December 2000X was still outstanding. So this entity had an investment at a bank that earned interest, but the bank has not yet paid that interest to the entity. The bank owes the interest to the entity, and anybody who owes something to the entity is a debtor. So the bank is a debtor for the entity. But now we need to look at how much income must we recognize for the current financial year. This investment was at the bank for the full financial year, so we need to recognize all the interest income for the full financial year. So the income for the current year is then the investment amount of 50,000 Rand times the 8% interest for the full 12 months gives us 4,000 Rand interest income that still needs to be recognized. The solution then is to credit that income account. So credit interest income. Remember, when you recognize income, you credit the specific income account. Credit interest income with 4,000 Rand, and then we debit what we call accrued interest income with 4,000 Rand. When a debtor owes you money, or when you sold goods to him or rendered service to him, you debited debtor's control, but that is concerned with the main activity of the business. This investment is not part of the main activity, so we are not going to debit debtor's control. We are going to debit another type of debtor's account that we call interest income accrued, or accrued interest income. But because it is still a type of debtor account, it will fall under current assets in the statement of financial position. Third adjustment is prepaid expenses. This happens when you pay an expense during the current period, but that expense has not yet been incurred. In other words, the supplier has not yet sold you those goods, or he has not yet delivered a service to you, but that will still happen, but it will only happen in the next financial year. So that expense has not yet been incurred, but you have already paid the supplier. That expense then belongs to the next financial period and needs to be taken out of the current year's figures and transferred to the next year's figures. Looking at an example for prepaid expenses, included in the insurance expense of 3,000 Rand for the financial year ending 31 March 2000X. So the financial year is from 1 April to 31 March, but included in the current financial year's insurance expense is an amount of 2,400 Rand in respect of an insurance policy, and that insurance policy is valid for the period from 1 January to 31 December. The current financial year ends on 31 March, but this specific insurance policy that costs 2,400 Rand extends beyond the 31st of March. So it extends past the current financial year into the next financial year. And the next financial year starts on the 1st of April. So from 1 April to 31 December 2000X belongs to the next financial year. So once again, we need to go and calculate what is our expense for the current year, what is the expense for the next year. And looking only at that 2,400 Rand, what belongs to the current year, first of all, let's look at what do we pay per month. 2,400 Rand divided by 12. That policy is valid for a year. So that's 200 Rand a month. How many months belong to the current financial year? January, February, March. So 3 months belong to the current financial year. The policy extends from 1 January. So from 1 January to 31 March is 3 months that are or that fall inside the current financial year. So 200 Rand times 3 months gives us 600 Rand that belongs to the current financial year. And then for the next financial year, if you look again at the 200 Rand per month, how many months fall outside the current financial year? And that is then from the end of the current financial year. So the new financial year starts on 1 April. The policy ends on 31 December. So from 1 April to 31 December is 9 months. So 200 Rand times 9 months, 1,800 Rand belongs to the next financial year. Our insurance expense currently in the trial balance is 3,000 Rand. Of that, 2,400 Rand needs to be split between the current year and the next year. So of the 2,400 Rand, 1,800 Rand needs to be taken out and transferred to another account where it can be kept for the next financial year. So if you have a look at what the expense is for the current year, we calculated that it is 600 Rand. So of the 2,400 Rand, 600 Rand belongs to the current financial year. And then if you have a look at the difference between 3,000 Rand and 2,400 Rand at 600 Rand, that 600 Rand is also the current year's insurance expense. But this specific example only looks at the 2,400 Rand amount. So of that, 600 Rand belongs to the current year, 1,800 Rand does not belong to the current year. It must be taken out of that insurance expense and put away to be kept for next year. And the solution to do that is then take it out of your insurance expense. So credit your insurance expense with that 1,800 Rand. Remember, expenses are usually debited. So to cancel that 1,800 Rand that has been debited to insurance, you need to credit insurance expense, 1,800, and then we go and put it away in a prepaid insurance account. So we debit prepaid insurance with the 1,800. And because prepaid insurance has been debited, it also belongs in the statement of financial position, and because it has a debit amount or a debit balance, it will be included under assets and specifically under current assets. So remember, all these adjusting journal entries, those accounts that we use to put the amounts away and where they are kept for the next financial year, must all go to the statement of financial position. And whether you debit or credit the accounts will determine whether it will be a current asset or a current liability. So if you debit the account, it will be a current asset. If you credit the account, it will be a current liability. Last new adjustment that we need to look at is accrued expenses. So this is expenses that are still owing. So they have been incurred during the current period. In other words, the goods have either been provided to you or the service has been rendered to you. So you incurred that expense, but you have not yet paid that supplier. So it must be included in the current financial period because it is an expense that then belongs to the current financial period. Looking at the example for accrued expenses, the water and electricity account of 750 Rand for December 2000X had not yet been received by the end of the financial period, which ends at the end of December. So this means that because the business had not yet received that water and electricity account, they have not yet paid it. So they used the water and electricity during December, which falls within the current financial year. So they have incurred that expense through the use of the water and electricity, but it has not yet been paid, so it is owing to the municipality. So the expense for the current year is then that amount of the account, which is 750 Rand. So in order to get this expense into the books, remember when you incur an expense, you need to recognize that expense. And when you incur an expense, you debit the expense. So we debit the water and electricity expense with the 750 Rand. And then we credit another account, accrued water and electricity, to show that we owe that money to the municipality. And remember that this accrued water and electricity account goes to the statement of financial position. It is not an expense account. It is a statement of financial position account. And because it has been credited, we show that we owe someone that money, so it must be included under current liabilities. The practical example that looks at adjusting journal entries will be shown in a separate video. Then we need to look at the post-adjustment trial balance. So this is the trial balance that you need to draw up once you have posted those journal entries to the general ledger, balance those relevant general ledger accounts, and then we need to draw up the post-adjustment trial balance that it includes all the accounts in the general ledger. So the post-adjustment trial balance includes every single account in the general ledger. So we start off with those adjusting journal entries. you prepare them, you enter them into the journal, then you need to post those journal entries to the ledger, you need to balance those accounts that are affected, and then you prepare the post-adjustment trial balance, including all the accounts in the general ledger. Practical example 2 then will prepare the post-adjustment trial balance for practical example 1. So that will be shown in a separate video. The second part of chapter 10 concerns closing transfers. This is where the income and expense accounts, otherwise known as the nominal accounts, must be closed off to calculate the profit or loss for the period. This means that the amounts in every income and expense account must be taken out of that account and transferred to specific accounts. The accounts that we use is the trading account and the profit or loss account. The accounts that are closed off to the trading account are the sales, sales returns, and cost of sales. You have already learned in chapter 4 which accounts get closed off to cost of sales. When the trading account is balanced, this results in the gross profit. If you do it as a normal formula, sales less cost of sales equals gross profit. So balancing the trading account will give you this gross profit. This gross profit is then taken out of the trading account, so the trading account is also closed off and transferred to the profit or loss account. Then all the other income and the operating expense accounts are closed off to profit or loss. When the profit or loss account is balanced, this will then give the profit or loss for the year. It is very important to remember that once the income and expense accounts have been closed off, they no longer have any balance. So the balance in every income and expense account is then 0. The order in which the closing transfers are done will be as follows. First of all, the accounts that are closed off to cost of sales, which you already learned in chapter 4, is the opening inventory, purchases, purchases returns, freight on purchases, and closing inventory. The cost of sales account is then closed off to the trading account as well as the sales and the sales returns accounts. And then the balance of the trading account is the gross profit or loss. This is then transferred to the profit or loss account, together with all the other income accounts and all the operating expense accounts. The balance of the profit or loss account is the profit or loss for the year, and the last closing transfer is then transfers that are done to the capital account, which is that profit or loss for the year taken out of the profit or loss account and transferred to the capital account. So once the closing transfers are done, the trading account and the profit and loss account are also 0. And then the last account that is also transferred to the capital account, in other words, it is closed off, so the balance will be 0, is the drawings account. Practical example 3 looks at closing transfers. That will be explained in a separate video. Now we look at the post-closing trial balance. So remember, you have done your closing journal entries. You have closed off all the sales, sales return, cost of sales, income and expense accounts. You need to post those journal entries to the general ledger. You need to balance those accounts that have been affected by the closing journal entries. And then you need to prepare your post-closing trial balance. Remember, all income and all expense accounts have been closed off. In other words, they are 0. So they will not be included in the post-closing trial balance. So what you need to remember that is very important is that your post-closing trial balance only includes asset, liability, and equity accounts. All the income and all the expense accounts are 0, and when an account is 0, you do not put it into the trial balance. Practical example 4 has a look at the post-closing trial balance, so that will also be explained in a separate video. Remember to work through the complete chapter in the textbook and then work through all the examples that are in that chapter as well.